We're really close to 20,000 on the Dow. The S&P 500, 35 points away from 2,300. It's been really good. You know, when you have a situation like this, it seems like the economic data that hits consumers always lags a lot more than most of us realize, me included. And so it's really nice to see. It's a little bit, on the other side, I guess, a little bit disheartening to see margins and sales down as much as they are in the brick and mortar stores, but that's just the reality of the world we live in right now.
So let's just look ahead into 2017 in terms of U.S. growth and how this will shape into expectations. You've noted in your morning report, in fact, regarding the current U.S. economic expansion is now the fourth longest on record in 90 months. Again, if this lasts through to spring of 2018, you've highlighted it will be the second longest. Just walk us through some of the numbers as you're seeing them.
Yeah, you know, it's just very interesting. I like statistics for the sake of statistics, but we do have to remember that every day is a new day, and relying on history is probably a fool's errand. But we're in unprecedented times. We're in the midst of a policy experiment that's never been attempted before around the globe. We have no idea how it's going to end up, and a lot of people are calling for the end of the stock market, saying we've rallied too far, too fast, et cetera. But let's keep in mind that global growth has been grinding at a very, very anemic pace for a long time. So this is just going to be a long, grinding economic expansion that we go from disinflation to inflation, fiscal policies becoming vogue again. These are all very good things for the stock market in aggregate. I mean, obviously not without risks, and some very meaningful risks, by the way. But that said, yeah, next year could be the third longest on record. In 2017, if we have a positive stock market, that would be 9 years in a row, even including 2011 and 15 when you have to add dividends back in. Treasury yields rallying again 3 years in a row. So it's just going to be a slow, grinding rally. It's a real hard rally to invest in, that's for sure.
But despite this growth that you are seeing for the U.S. economy, you're also forecasting that the U.S. merchandise trade deficit will widen, not narrow. You know, despite some of the spending measures that President-elect Donald Trump is anticipated to be introducing.
Yeah, that is exactly true, and I think you know, there's going to be a lot of upward pressure on the U.S. dollar, and who knows what that will do to the scarcity of the dollar. And you have so much global debt, especially in the emerging markets, that's denominated in U.S. dollars. It could really spell trouble. But on the consumer side, at least here in America, you know, we would become beneficiaries of all that in an unfortunate way. And so that is just going to continue to keep people spending money, especially on imported goods, as they get cheaper relative to the dollar.
So let's bring this back to markets in terms of what we're seeing, and certainly in these last few days of 2016 trade. The S&P 500 posting a positive total return for the 9th year in a row. Again, is this, I suppose, is this a bull run that you see continuing into the new year?
I do, and recall in the beginning of 2016, I really was not bullish on America, the stock market. I did think we'd see single-digit returns, but better returns elsewhere. And I think the same is true in 2017. I think there's better value elsewhere, although I still see upper single-digit returns for the S&P 500 and the Dow. But it's just going to come with a lot of risk. It's going to come with picking the right sectors. So being diversified probably makes a lot of sense. So I want to repeat what I said before in 2016, early on, is that, yeah, I do think the economy is in good shape. I just think the risks are really high, and I think the opportunities are better elsewhere.
So just taking a look, lastly, Larry, we've seen overnight U.S. 2-year Treasury yields rising to a 1-week high. Would love to get your outlook for U.S. bond yields in the year ahead. Obviously, over the last 2 months, they've been a huge theme of trading globally. But what does 2017 hold?
I think it's going to be a real scary year for the bond market, and obviously that's going to play into every other market, especially the stock market. Depending on how yields go, I mean, I think everybody's expecting Consensus expecting 10-year yields somewhere between 2.75% and 3% this time next year. That's what they were expecting this time, by the way, a year ago. But the problem is there's so much debt on the books right now, non-financial debt. And I think any kind of downdraft in the bonds is going to be really, really scary for a lot of people. So we're going to see a lot of volatile moves, just like we saw after the election with the 10-year yield. And at this point, people are still trying to figure out why yields have gone up so far and so fast, not realizing that they were extremely low for a very long time for no real reason whatsoever. So I do think 3% is about right this time next year for the 10-year yield. We're going to continue to see steepening, but it's going to be a real scary time for the bond trader, just given the variety of agonies that will happen between now and next year.